Hey guys, how are you? I hope all of you are doing really good. So welcome to Economics for Finance Excellency Batch. I'm your guide, your mentor, CA Saurav Jindal from KSJ Teaching, taking you through this beautiful journey of economics for finance and making sure that you love this subject and score maximum marks in it. Okay, so let's start with this. Now, we have completed the last chapter, that is money demand, and we are moving on to our new chapter, that is money supply. Now we say if we are demanding something, there should be a supply of that also, right? Otherwise, what is the purpose of the demand, right? There is no purpose of demand otherwise. So when we say that there is a demand for money, there should also be a supply of money. Now, what does it mean by supply of money? What are the various sources of the supply of money? All these things we need to study in this particular chapter, and we will be covering a few numerical topics also in this particular chapter from the ICAI module, right? Okay, let's see what is the concept of money supply. It says the money supply denotes the total quantity of money available to the people in an economy, that how much of the money the people in an economy are having, that is known as the money supply, right? How can the people have money? Only if the money is supplied into the economy, only then the people will have money in hand for the expenditure purposes, isn't it? Only then the people will have money in hand for the expenditure purposes. He says the quantity of money at any point of time is a measurable concept, that we can measure that how many 2000 notes are there in the economy, how many 500 notes are there in the economy, because each and everything when the money is supplied by the higher authorities, each and everything is recorded, right? So if you look at the banking operations, sir, every day they have to count what are the number of notes of 2500. All these things are properly recorded, so we can measure at any point of time that how much of the money is in supply. In supply means how much of the money is there with the people in an economy, right? Is that clear? Now, let's see what is this supply of money. Supply of money, it refers to the total amount of money that any particular point of time, that is there at any particular point of time with the people, that we have understood, right? Now, he says it is a stock concept. What does it mean by stock concept? Sir, you are having money in your pocket. You are keeping that money in your pocket. That is a stock. That is an inventory that you are having. You can use that money for any purpose at any point of time, right? So it is a stock concept when you are keeping the money. And now when you are spending money, that means there is a change in that stock, right? Or you receive money from somewhere, again there is a change in the stock, that becomes a flow variable. He says change in the stock of money, increase or decrease, is a flow variable. When till the time the money is there in your pocket, it is lying there as such, no spending, no extra receiving, that becomes a stock concept, right? But as soon as there is a change in that stock, as soon as the money is increasing or the money is decreasing, supply, basically the supply of money is increasing or the supply of money is decreasing, as soon as there is a change, it becomes a flow variable, right? So what is a stock of money? It refers to the stock of money available to the public as a means of payment and the store value. That means whatever the money is there in your wallet, right? That is the stock that you are having. For what purpose? For the purposes of payment, and for the store of value means for meeting any future expenses or meeting any future contingencies. When you are having the money in your wallet, that is known as the stock of money available to the public. It is always smaller than the total stock of money in an economy. Why it is so, sir? It is always smaller than, let's say you need 1000 rupees, right? You go to their, you need 2000 rupees. Now you go to your father, you ask for the 2000 rupees, right? Your father is having the stock of 2000 rupees. That means there is a 2000 rupee note in his purse, right, in his wallet, but he is going to give you only 1000 rupees, right? So what is the amount that you are going to have? That is 1000 rupees, not 2000. Why? What is the reason? The reason is very simple, because the father is really worried about you, that his son or his daughter doesn't get spoiled with the money, right? So what is that? The same thing is with the economy. The higher authorities say whatever the total amount we have, but the supply that is in the hands of the people, whatever the stock will be available, that will be less than what is actually there for the economy, right? So this is an important concept, because if people will have lots and lots of money in hand, if people have everything in the hand, then people will go for the spending, and more the spending means there will be rise in the prices, and the rise in the prices will lead to what? The rise in the prices will lead to inflation process, right? So that is why it is very important. The government says whatever the whole money is there in the economy, we will supply only a part of it. Slowly we will leave into the economy, so that people do not have huge stocks of money in hand. Clear? So that is the purpose here. Now he says, what does it mean by public? We are using the word that whatever the money is available to the people, or the stock of money available to the public, who all are included in the public. The public doesn't only mean that the you and me and the public which is there. The public means the other institutions also, right? So he says public means all the economic units, households, firms, institutions, quasi-government institutions, etc. Quasi-government, which are the quasi-government institutions? That means where the institutions are not fully governed by government, but government has some share in that, right? Except, now what is he saying? He says, except for, what is to be excluded from the definition of public? He say the producers of the money, that is the government and the banking system. So these are not included in the public, right? So public is beyond the institutions or the government who are manufacturing the money, who are the producers of money. Other than that, everything is included in the definition of public, whether it is a household, whether it is a business firm, institution, quasi-government institution, except the producers of money, right? So interbank deposits and the money held by government and the banking system are not included in the standard measure of money. That means if one bank has deposited some money with the another bank, right, is having a balance with the other bank, in that case, is it a supply of money? No, it is not a supply of money, because the other bank with which the this amount is kept, that is not a public, right? So in the public definition, we are not including the producers of money. Rest everyone will be included in the definition of public. Clear? This much is clear to you? Now, further he says, what is the significance of measuring the money supply? That what is the need? What is the benefit of measuring the money supply? He says the stock of money, the money supply is responsible for the changes in the many macroeconomic variables in the economy, right? So whatever is the stock available with the people, or whenever there is a change in the stock of the money, it is the supply of money, right? So money supply, stock of money is dependent upon what? The money supply, right? So whatever the money is there in the hands of the public, so it changes many macroeconomic variables in an economy. How, sir? More the money supply, more the stock available to the people, more the money available to the people for spending, and that will impact what? That will impact the prices, which is a macroeconomic variable. That will impact the inflation, that is again a macroeconomic variable. So he says the money supply is responsible for changes. Whatever the stock of money is available, that is responsible for the changes in many macroeconomic variables in an economy. Economic stability. The economic stability requires that the supply of money at any point of time should be maintained at the optimum level. Now, if there is optimum level of supply, that shows whether the economic stability is there, or the reverse is also true, that if there is economic stability, that shows that the money demand and money supply are in balance, right? There is optimum level of supply, because sir, what will happen if there is shortage of the supply of money? In that case, the economy will go into the recession mode, and if there is excess of money supply, the economy will go into the inflation mode, right? So if there is, two situations can be there. If there is no economic stability, either it can be the shortage of money, right, or there can be excess of money. Now the shortage is what? Shortage will lead to recession, because people will have less money in hand, they will spend less, the demand will be less, the prices will go down, and the economy will go into recessionary mode. Whereas if people have excess of money in hand, then it will lead to a situation of inflation, right? Because the people will have more money in hand, more demand means more prices, increase in the prices, and that will lead to inflation process, right? Then is the analysis. The money supply facilitate the analysis of the monetary developments to provide a better understanding of the causes of the money growth, right? So during any time, the money supply also helps in analyzing whether whatever the monetary policies are made by the government, whether those are being implemented in the right direction or not, right? So monetary policy, even the monetary policies, that analysis is, we are going to analyze that the whether our money is strengthening or not. So it is again dependent upon the money supply against the other countries also, when we are trying to identify that whether our money is gaining the strength or not, right? Whether the value of money is increasing or not, whether the value of money is decreasing or not. So all these things are being facilitated through the money supply. So next is monetary policy. Analysis of the money supply is essential from the monetary policy viewpoint, as it provides a framework to evaluate whether the stock of money is consistent with the standards of the price stability. Now, if an economy has to be in the stability, the price stability is one of the most important factors, right? Because the increase in prices will lead to inflation, and the reduction in the prices will lead to recession. So he says the government always look at the various policies through the prices, right? Whether the prices are stable or not, right? And if the prices are stable, and this money supply, the study of the money supply helps in analyzing whether the objectives, whether whatever the money is being supplied into the economy, that is consistent with this price stability motive of the government, right? Because that is one of the most important motives, I will say. Understand the nature of deviations from the standard. If there are any deviations, now the government says that the price of per bread, let's say bread, this is the basic necessity, sir, right? The government says the price should be 40 rupees, and it should be stable around 40 rupees only. But now if this price increases to 60 rupees, right, the government will need to look at the various ways. Why the prices have increased? That means the people might be having more money in hand, they are spending more money, right? The supply is very high, the supply of money is high, so that people have more money in hand and the people are spending more. That is why the companies are taking the benefit of that and increasing the prices, right? So what will the government do? They will try to push money out of the hands of people, right? So this money supply again helps in analyzing the one thing, the price stability, and another thing, understanding the nature of deviations. If there are deviations from the standards being set, then they need to be studied, that why there are deviations in from those standards, right? So this was the significance. Now the sources of money supply, sir, how this money is being supplied into the economy. So if we look at it, if I look at the sources of money supply, what are the sources? Sources of money supply. Sir, there are two major sources of money supply. What are those two major sources? One is the money supply by the central bank, money supply by the central bank, and another one is the money supply by the commercial banks, right? So let's take an example of India only. What is the central bank here? The RBI. And what are the commercial banks? All other banks working under the RBI, right? It can be SBI, it can be ICICI, right? It can be HDFC. These are what? These are the commercial banks which are into the commercial transactions, right? So he says, what are the two sources? One source is the central bank. How the central bank is a source, sir? The central bank prints money, right, and supplies it into the economy, isn't it? Sir, this central bank holds the whole responsibility. The main, I can say, the regulator of the money supply is the central bank, because the central bank is responsible for printing the money. Central bank is responsible for controlling the supply of money in an economy, right? That how many notes should be there in the economy, how many notes should not be there in the economy. So everything is being decided, or everything is being provided by the central bank. So it is one source of money which is printing the money and providing the money into the economy. Now, whatever the money the central bank is provided, what is this money called as? This is known as high powered money. This is known as high powered money, or this is also known as fiat money. This is also known as fiat money, right? Now, what about the commercial banks, sir? How do the commercial banks lead to help in the money supply? Can you think of any reason? Let's say there is Mr. X. Mr. X deposited 10,000 rupees in his savings account, right? So Mr. X has deposited 10,000 rupees in his savings account. Now, what will the banks do with this 10,000? Now, Mr. Y approached the bank and asked for 10,000 rupees as the loan. So, what will the banks do? The banks will use this 10,000 provided by Mr. X. They will give loan to Mr. Y, right? So this is how, this is again what? This is again, this process is the supply of money, right? They are taking the money from one person and they are supplying it to another person who is in need of that, who is demanding the money, right? So this is how the commercial banks lead to the supply of money, right? So these are the two major sources of supply of money. One is the central bank, that is the RBI, and another one is the commercial banks who are into the procedure of lending, right? They take the money from one person and they lend the money to another person. That is how they are creating the supply of money in an economy. Clear? The major part is clear, right? Now we'll see what is given in the books. Central bank. The central bank's decision determines the money supply in an economy. As I told you, that central bank is the major regulator of money, that how much of the money is to be there in the hands of the people depending upon the economic situation, whether there is recession, whether there is inflation. So the central bank decides that how much of the money supply should be there in an economy. The central banks are empowered to issue the currency, and hence it is the primary source of money in every country, right? So one thing is important, sir. This is the primary source. This is the primary source. What does it mean? It means that the commercial banks cannot solely work, right? That means they are not the sole, they cannot work as the independent suppliers of the money. Let's take an example. If the central bank is not there, will there be any authority to print the notes? No, sir. Print currency? No, sir. Then how can the commercial banks take the money and lend the money? That will not be possible there. So central bank is the primary source of the supply of money. High powered money issued by the monetary authorities. Monetary authorities being issued by the central bank, right, is source of all other forms of money. That is what I told you, that if the central bank is not issuing the money, then will there be any money for the lending? No, sir. There will be no money for the lending purposes also. So that is why it is known as high powered money. That without, this is the most powered money which is being issued by the central authorities or the central bank of the country. The currency issued by the central bank is fiat money. It is backed by supporting reserves and its value is guaranteed by the government. Now, this is again important, that whatever the currency the central bank is issuing, right, it is supported by the reserves. Reserves are what? Reserves can be gold and forex reserves, right? In case there is any hit to the money, right? So one thing, the value is guaranteed by the government. If it is a 2,000 rupee note, you will check that the value is guaranteed by the government. It is written there, I promise to pay the bearer this value, right? And who is there on that? The government sign is there, right? So that means value is guaranteed by the government, that if there is a particular 2,000 rupee note, it means that you can buy anything worth 2,000 rupees and nobody can stop you, right? So this is what is the value given by the government, and whatever the money is available in the economy, it is always backed by some foreign reserves or anything. In case something bad happens with the money of the economy, then always you have the reserves, the gold reserves. You can sell that gold and get the money, right? Let's say the money is exhausted in the economy, there is no more money, you can't print more money and everything is exhausted in the economy. Then out of these forex reserves or out of the gold reserves, if you have, what are the forex reserves? You have the foreign countries accounts with you, right? You can use that money. Clear? So this is the first one, that is the central bank. Then is the banking system. The banking system here means the commercial banks. What does it mean by the banking system? It means the commercial banks, as I told you. Right? So the supply response of the commercial banking system to the change in the policy by central bank also determines the money supply. Now he says all the policies are being created by the central bank, right? That how much of the money should be there in the economy, and the commercial banks have to apply those policies. Commercial banks have to work according to those policies which are created by the central bank. Now, how, sir? Let's take an example. Mr. X deposited 10,000 rupees into savings account, right? And this 10,000 is, this commercial bank has lended to Mr. Y. Now, if the RBI changes the policy, RBI says if Mr. X is depositing 10,000 rupees, you can give further only 80% of it, that is 8,000 rupees. Now, what is the money supply? Money supply is 8,000. The rest of 2,000 is, the RBI says you have to keep it as a backup reserve. Right? So he says the supply of money by the commercial bank is dependent upon the policies being created by the central bank. Right? Total money supply in an economy is determined by the extent of credit creation by the commercial banking system. What is credit creation? Credit creation is taking the savings and lending it to some other people. Right? So money created by the commercial banks through the process of borrowing and lending is called the credit money. So this is how the money supply works. Deposits, right? Deposit, and the banks then will, new loans will be given, principal repayments will be done. Clear? So both ways this is working. Once you are giving the money also, once that person, when the returns the principal money, that money goes again into the banking system. So this is how the commercial banks help in the supply of money, right? So we have done the two major sources of the money supply. One is the the central bank, and another one is the commercial banks. I hope this much is clear. So this was the basics of the money supply. What is the concept of money supply? That if it is lying in your pocket, it is a stock concept. But whenever there is a change in the stock concept, it becomes a flow variable. So stock of money is at any point of time, what is the available amount of money that is there with the public. Who all are included in the public, sir? Except for the producers of money, everyone else is included in the definition of public. So interbank deposits not to be included in the public, sir. In the supply of money, significance of measuring the money supply discussed. What are the two major sources? Two major sources are the central bank and the commercial banks, right? So in the next lecture now, we will start with the measurement of money supply in India, how the money is being measured in India, right? So for measurement, there are monetary aggregates, then there came the new monetary aggregates, then there were liquidity aggregates. What are those? What are the various things which are included in these things, right? So we'll study about the monetary aggregates, what all is included. Then we'll study about the reserve money. What is the reserve money, sir? Then we'll study about new monetary aggregates and the liquidity aggregates. Now this is a part where we will discuss some part, but again you will have to remember a few things here, because these are the aggregates which are as such given by the government, right? It is like a rule that is given, so you will have to remember that rule. Clear? So there is no, I can say, the concept by which we can remember. You will have to practice, read it multiple times, and you will be able to remember the multiple things, right? Then there will be determinants of money supply, concept of money multiplier, which is a very important part. Money multiplier approach to money supply, again very important part, sir, right? Credit multiplier is there, ratio of currency to CDR, that these are small easy topics, right? But money multiplier is an important topic. But for the next lecture, what we are focusing on is the monetary aggregates or the measurement of the money supply in India, right? I hope all of you are absolutely clear with this thing. And guys, very important, all those who have not yet ordered the books, they can order it from the website ksjteaching.org. This is a very small investment, right? It is an investment for your future, and this is a contribution for the KSJ teaching, for the cause, that educational cause that we have started, that quality education must be made affordable. So it is going to be a small contribution from your side to that cause, and we'll keep on posting such content for all of you. We are providing absolutely free of cost the whole course, just the investment in the books, right? And it sometimes feels bad even then When we are providing everything free of cost with such a small investment, the people are asking for the PDF and people are asking for notes in the groups that please provide it free of cost. If you are not ready to invest even this much in your future, then how can you expect a return in the future? I really wonder. Then how can you expect a return for your future if you are not ready to invest 1000 rupees in your future? That's really strange. That's really strange. Anyhow, so that's what I can request to all of you, that please like the video, share with all your friends, subscribe to the channel, right? And do make an investment as per your choice, right? But that this is a huge investment. This is going to be a very good investment for your future, right? It is not going to be a waste expenditure. It is not an expenditure. I always say it is an investment into your future. Please start investing in your future to gain something in the future. Otherwise, what you will be doing is you will not be having a bright future which you are dreaming of, right? You might be living a very ordinary life but not an extraordinary life that you actually deserve, you actually are dreaming of, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.